um, and how you manage those. Today we're going to look a little bit closer at liquidity and liability management. So we looked at liquidity management to some extent when we did the deposit drain, how institutions deal with deposit drains. So there are two ways they deal with them. Use store liquidity management and purchase liquidity. With store liquidity management, what do they do? With store liquidity, they use some of their assets, so they might have some cash, they might have some investments, and so they use from that. I don't like to say so cash, all right? Now, if they have to go into their equity reserves, right, then it means they're messing with their solvency, all right? So they need to have enough equity to be able to handle that. And that is why regulators look for capital adequacy ratios of 8%, and then they also have different ways of calculating to see if you have enough capital to cover all of the eventualities that you have. All right, so liquidity poses a risk, or lack of liquidity poses a risk. So the capital adequacy requirements look at that as well. All right, let's see if my computer will cooperate now. Restart. So we're going to take a little closer look at liability, liquidity and liability management today. It's not a very long section, but we'll spend some time on it. We haven't discussed sovereign risk in any detail, but I'll cover that next week. Next week we cover whatever we do. It's not much. It's really not much. Oh boy. It says it's working on it.
Do you know how much RAM they have? How much RAM?
It's new, and yes, it's not 16, it's more than 16. I'm pretty sure I made sure to buy a laptop with more than 16 gigs. More than 16
gigs of RAM? I need more than 60 gigs.
Well, don't need more than 16 for sure.
Lots of documents. I don't put everything in the cloud. I mean, I have access to OneDrive and all of that, but and I do pay for extra storage on the drive, but I don't.
No, it shouldn't. So,
Try this again.
liquidity risk. How?
Right, so in terms of objectives, we're going to look at, you should be able to explain the different types of items on the liability side of a financial institution's balance sheet. We'd have done that at the beginning, all right? So I shouldn't even have to go over that with you, but we'll still talk about it. Analyze the risk versus the cost of liabilities to a financial institution. Explain reserve requirement process. Calculate reserve requirement amount using given reserve requirement ratio. So, you know, we spoke about reserve requirements when we were talking about credit risk. We spoke about it then, we spoke about it a little earlier on as well. So, in this, we're looking at, first you have to understand what the liabilities are, know what risk they pose before you can actually manage them, right? So you have the liquidity management side, which we know that you manage your liquid asset position. Liquid asset position means your cash assets and your near cash assets, all right? So your cash assets would be what? Money, the actual cash accounts. Your near cash will be your, any deposits you have at the central bank, any fixed deposits. So your money market instruments, those are near cash, all right? So with the liquidity management, you're managing your liquid assets position. So you want to make sure that you have sufficient liquid assets to cover your daily obligations, but at the same time, you don't want to be losing any interest, potential interest that you can get by holding too much cash. Because when you hold cash, you're not really getting a return on the cash. Then you have the liability side. So liability management is where you manage your liability structure. So what is that liability structure is what we need to look at, okay? So like I just said, when you have a lot of cash, you are not going to be making money on that cash. Cash brings you very low returns. Cash and near cash assets brings you very, very low returns. All right? So you don't want to have excessive liquidity, nor do you want to have excessive illiquidity. All right? Because if you don't have sufficient liquidity, that could lead to solvency. We saw that in we see that with the deposit drain, if you don't have that liquidity and you don't have the cash to deal with it, you're gonna have a problem. Also, if you don't have liquidity, then it means you're now going to have to sell off assets, all right? If you have to sell off assets, you're selling off at fire sale prices, which means you're going to make a lot on those assets, okay? So, with excessive illiquidity, you're going to have that insolvency because you're not able to sell those assets quickly enough to increase your position. All right? So, the central bank as regulator requires that financial institutions hold a certain amount of liquid assets to meet both the expected and the unexpected. And so, there's the ratios that you use to monitor that. Then, of course,
What type of ratios?
huh?
What type of ratios? Yes.
What are the liquidity ratios?
Liquidity ratios.
What are your liquidity ratios? I'm asking Darwin, because Darwin is about to graduate. And he asked me the question.
What are
Supposed to know.
liquidity ratios?
What major you
Is
are,
it-
Darwin?
Accounting and finance. So that. Is it like current ratio? No?
Mm-hmm.
Quick ratio? That's
Mhm.
oh, okay. There are only two I know, I guess.
Maybe just say, maybe just say.
All right, let me just,
Okay.
you know, that little question. I understand.
Yeah.
All right. So, also, the central bank will be able to use implemented monetary policy through the banking system, through increasing, decreasing the money supply. If you're increasing the money supply, you're providing more monies to the system. One of the things, before I go on, one of the things that you will recognize when you are reviewing the financial statements for your project, you're going to observe that the banks in our region, for those doing banks in our region, are very, very liquid. And you may ask the question, but aren't they losing money because they are too liquid? All right? And that's something that the banks do because of our vulnerability to natural disasters and the other external shocks, right? So they hold liquidity in the event that we have that. The other thing, they're very conservative on credit. They're very, very risk averse. And so they don't give a lot of, they have very tight credit guidelines, right? And so you'll find that giving out loans, especially to like small businesses and so on, they don't like to do that, but they do it now because there's a guarantee by something called Eastern Caribbean Partial Credit Guarantee Scheme that guarantees a certain amount of each loan for small business. But the small businesses still have to go through the process of the looking at where they look at the 5 C's of credit and they assess that. All right. Now, how does the central bank help the commercial banks to manage their liquidity? One of the things they do is they use the reserve requirement. They use a reserve requirement ratio, where the commercial banks must keep a minimum amount of liquid assets, all right? So it's, in Antigua and Barbuda, it's 6% of deposit liabilities that they have to keep in reserves, all right? In other jurisdictions, the ratios are different, all right? So they will have, so for example, in the US, they will have a rate for checking deposits, they have a rate for savings deposits, all right? They have a rate for demand deposits, so they're different rates, they're different tiers. And they use that reserve requirement to ensure that the commercial banks have a certain amount of reserves, okay? Back in the early 2000s, early to mid 2000s, when the ABI Bank was having difficulties, the ABI Bank, where the central bank saw the difficulties was that they were very often breaching their reserve requirements. When you breach reserve requirements, you have to pay a fine, right? And so that was like the first sign, one of those first signs that there were problems. But then when you look at the equity, all right, their capital, some of their capital, they had a lot of loan impairments. That's one of the things that brought them down. People were not paying their loans, right? And so their capital was being eroded. So they had both a capital adequacy issue and a liquidity issue. And so eventually ECAB would have taken on some of its good assets, whatever good ones it had left, whereas the government would have, quote unquote, taken on the responsibility for those depositors who had deposits over a certain amount. All right? So what the government did was to issue a bond and put the bond in trust with the Depository Protection Trust. All right? The Depository Protection Trust Company. And so how the persons who had large deposits in ABI are getting their money back is that with this bond, it's what you call an amortized bond. So there's a portion of the principal, a portion of the interest that is paid. So at one point in the year, you get some interest. Another point in the year, you get interest and principal. So that's how those depositors are getting back their money, right? And there are a lot of depositors, both institutional and individual, who had a significant amount of cash in ABI Bank, right? So ECAB would have taken on the good loans, okay? The bad loans were put in a company, in the receiver, okay, the receivership, and so that is how that was dealt with. But ABI had to, the government was assisting even before the bond. The government was assisting because the government was putting most of its deposits with ABI. So government collects money every day. And so it would deposit into ABI just to keep it going. But then the government recognized we can't do this forever, so we need to fix the problem, right? So in terms of managing that liquidity, using the reserve requirement, there's a way to do that, all right? It's not that you have 10 million in deposits and you reserve 6% of, how much is the reserve deposit that? 6% of the 10 million, right? And you put it away at the central bank. That's not how it works. There's actually a reserve maintenance period where you have to maintain a certain amount of money at the central bank, all right? And so over that period, you have to either meet or exceed the required reserve targets, okay? Bearing in mind, that if you're over the reserve requirement, there's no interest on that. Okay? And so there's a lag between the period in which your reserves are computed or calculated and the actual reserve maintenance period. Okay? So, but in our jurisdiction, it's an average of your deposits over a period of time. All right, so like the first or the second 3 weeks of the month, and then the requirement is calculated. And so you have that lag, you have a 1 week lag in which you can sort of be a little flexible, all right? But the reserve requirement is calculated on that period. Okay, whether it's 3 weeks, 2 weeks, and then your account must have that amount in, the commercial bank's account must have that amount in the account. All right, so, and then you have to hold that amount in the account for a certain period of time, okay? And like I said, there are penalties. You have to pay a fine to the central bank if you don't, if you're short on your reserve. So commercial banks try their very best not to be short on their reserves, because the minute you're short, it's a signal that something is wrong. Okay? Now, when you talk, so that's the main tool that is used to measure your, to manage liquidity. All right? Banks will keep excess reserves because they know that they, on a daily basis, they need a certain amount of money to cover their transactions. And so the Bank for International Settlements tells the banks that they need to have the system in place whereby they can calculate that, whereby they can monitor on a daily basis, look at the trend over time to see how much money they need. And so there are some periods where you normally need higher liquidity, and so the banks manage that pretty well. The central bank helps them to do that, because the central bank itself also keeps cash on hand. So they need cash, they know when they're going to need a certain amount of cash, and so they do that movement of cash. I'm sure I probably said this already in another class, but particularly on a Wednesday, you tend to see movement of cash happening on High Street, right? But they do it at different days now, they do it different times. So different banks have different days when they get their extra cash and so on. All right, so that's on the liquidity side. Okay? Now, on the liability side, there are some things that the financial institutions need to do. So, before we get into that, let's take a look at what is on the liability side of a bank's balance sheet. Well, what are those, what is on the liability side of a bank's balance sheet?
Deposits.
So deposits, So you have demand deposits, let's call them demand deposits, because you can come and take your money anytime. All right? You have fixed deposits. What else you have? What else does the bank have on the liability side? Loans. outstanding loans. Anything else?
Repos,
Huh?
repos.
Repurchase agreements, okay, you know what a repo is? Savio?
Little shaking that.
Anybody can help Savio what a repurchase agreement is? Hmm? Basically,
Isn't that when, it's a short-term security where, I know what it is, but I can't put it to word. I know what it is.
it's a short-term security, it's like a short-term loan, but
You
with the use
write a
of
contract that
treasury
you're going to buy
bills,
back.
yes,
Yes.
you write a contract, yes, okay? All right. Some banks have pension liabilities. And let's just put other. Okay? You also have lease liability too. I just want to put that in there. All right. But we know that the main ones would be these, yeah?
Yes.
Okay. Now, you have your deposits, you have fixed deposits. Fixed deposits, you know when they're going to mature. And banks will charge you a penalty if you break your fixed deposit. All right? So they give themselves a little insurance there. But with demand deposits, they don't know when you're going to come for your money. All right? And so they need to monitor how you take your funds out. All right? They need to monitor what is happening in the economy that may make persons come and withdraw their funds. All right? And they also need to remember that if they are doing any activities that are against what the public thinks they should do, persons may say, I'm not going to put my money with that bank again. If they have poor customer service, somebody may go and take out their money, all right?
Well, that comes
So-
in under reputation risk.
Yes. Right. So once the depository institution manages its liability structure well, then that is going to reduce the need to hold a lot of liquid assets to meet liability withdrawals. So as an institution, you are, like I said, you have to monitor the trends. You have to see when do most of your customers get paid. We know that just looking at how they run the ATMs, I don't think they run them very well. You know that the demand on Friday afternoon is high. So go refill the ATM at some point Friday evening so that Saturday, people like me who don't go in the rush on a Friday, I don't really go on the ATM on Friday anyway, will be able to have some cash, right? So you know the ATMs that normally run out of money. And so these days, people just, they prefer to get paid, a lot of people prefer to get paid by check and they go to the gas station and they cash the check. At a cost, yes, but they're sure to have their cash in their hands. But that's an aside. So the improvements in technology has really assisted financial institutions in managing their liabilities. All right? So you have internet banking, you have mobile banking, everything is on your phone, you can do everything on your phone. And so because you have direct deposit of payroll, okay, so we deposit our pay directly to the bank. We doesn't pay anybody by check If UB owes you, you need to give them the banking information, but they're not writing you a check and they're giving you cash. They're going to put it in your account. And so, as simple as they may seem, these technological improvements have assisted banks in managing their liabilities. Why? Because they are able to, with internet banking, where you're just transferring between accounts, you're not actually using cash. All right? You're transferring balances. So there's no cash need there. All right? Even if you're paying another bank, somebody whose account is in another bank, it's an accounting transaction. All right? So if Jahim owes me and needs to pay me, then Jahim can, we're at a different bank. Jahim's at ECAM, I'm at ACB. Jahim can pay me using electronic funds transfer, all right? And that transfer simply takes the money from Jahim's account, all right? Sends it to my account. How does that work? ECAM and ACB have an account at ECCB. They may even have accounts among themselves. And so when that transfer is done, it's really just an accounting entry, okay? The other thing that the internet banking, the mobile banking, the direct deposit does is that because it's all on an electronic platform, it mines the data, it collects the data, right? Now, in developed countries with very large banks, that data is mined and stored. I'm not sure that it's done as much here, but the banks are beginning to become more cognizant of what that can do for them. And so the electronic transactions help some institutions to collect that data, which is going to help them to monitor the movements on a daily, weekly, monthly basis. So they look at the trends, they look at what is required, they look at patterns, all right? And so they're able to manage better. Now, right now in our jurisdiction, you don't find banks are clamoring for customers. They clearly cannot be clamoring for customers when it takes so long to open an account. Any bankers in here?
What?
You work in a bank? Oh. Anybody work in a bank in here? You don't have to say. So point I'm making is they clearly cannot be clamoring for accounts if they take so long to open an account, for you to open an account. So, but when banks, the business of banks is to attract deposits, to take deposits and to give loans, right? When in attracting those deposits, they want to ensure that the deposits that they're taking in will cost them as little as possible, right? So they're going to have different types of accounts that is going to help them to minimize their cost, okay? So they're taking in deposits to give loans. And so they're trying to minimize that cost to, that funds their loans, all right? At the same time, they want to get some return on the money they are giving out, right? So they want a low-cost source to fund these loans. And that is where they have the different categories of deposits. So I remember once upon a time, very long time ago, Scotiabank had a deposit where you could have a check-in savings. How does that work? You had to keep a certain amount in the account, all right? Anything above X amount, you would get interest on it, okay? You could not write more than a certain amount of checks a month. If you wrote more than, I think it was like 5 checks, or went to the ATM 5 times, you would get charged. All right? So the banks, they work out their ways of having access to the funds coming in as deposits and paying as little as possible on those funds. So for example, your savings deposit attracts 2%, but try to set up a fixed deposit. It could be $2 million. The bank will tell you 1.5%, which is less than savings, right? So banks try to pay as little as possible on their deposits.
2%.
And so they'll take the money in. They want to keep as little cash as they need to as possible, because what they're now going to do is to take that excess liquidity and invest it to make a profit. So banks are going into the market now, into the financial markets. They're buying stock, they're buying bonds. They're buying not just bonds, but they're also buying stocks, right? And they're getting involved with a lot of different financial products or securities. And that is why the 2008-2009 crisis had hit them so hard, all right? Because they were involved in those markets. So, financial institution or depository institution, as they call it here, must manage the type of accounts they attract and the number of accounts they attract, all right? And they have metrics for determining how much they want to attract, all right? And how much of a particular type of account they want to attract. So they have, like I said, various metrics that they use. So a demand deposit is a withdrawal. You're able to withdraw without notice, all right? No interest is paid, but there are other costs to holding that deposit. So you have printing checks, processing checks, issuing statements. You find nowadays the banks don't want to issue statements. All right, you have to do it online. And for right now, for businesses, because they are requiring some businesses are still asking for their paper statements, you get charged for a statement if they have to print a statement and mail it out to you, because there's a cost to that. Ink toner is expensive, right? And so there's a cost to that. So what they do is to work out the rates that they're going to charge, all right? So in this case, you have what we call the average implicit interest rate. How did they come up with that? They look at the average management cost per year. So the average cost to manage all of these accounts per year. From that, they subtract the average fees that they earn per account per year. All right, remember they charge you for everything now. You have to pay $5 for this, $5 for that. You're doing the EFTs, you're paying $5 per EFT. So if you're using an EFT, you could as well try to put all of your transactions, do all of your transactions at the same time and just move one amount of money. Because if you're doing an EFT every week, that makes no sense. Spend a lot of money. And then they're going to divide that by the average annual size of the account. So they come up with an average implicit interest rate that they are going to that's the interest rate that they are going to give on one hand, charge on the other. Remember, on the loan side, they look at the return on a loan and the different elements of that. And so they use that on the loan side, right? And then in terms of how much they're going to pay on the account, they are going to look at They're going to look at the cost of managing the account, the fees that they earn on the account, or the potential fees that they earn on the account, and the average annual size of the account, right? So that's how they determine how much they're going to pay. Then you have, so those are demand deposits. You have interest-bearing checking, or what you call now accounts, okay? Interest-bearing checking accounts, like I indicated before, they require minimum balance, all right? And once you maintain that minimum balance, then the bank will pay you interest. If you don't maintain the balance, the bank is not going to pay you interest, okay? And so the bank is going to calculate its gross interest return, which is its explicit interest rate, plus its implicit interest rate to get its gross rate account, its gross interest return. And we'll do some examples of that, all right? But I just want to finish. I just have one more slide, and then we'll look at the examples. All right, so let's have a look at some of the other types of accounts. I know there's too much light, so you're not seeing as well as you should, but I'll speak to them, and you have this file, you have the slides in your in Moodle. So the other types of accounts, you have passbook savings. Interest is paid on those accounts, but there are restrictions on withdrawals. All right, so if you withdraw, you're gonna get a penalty, you'll get a charge. All right? Then you have money market deposit account, which is a savings deposit with limited checking account features. Then you have something called a real-time deposits and CDs. So you have they are fixed deposits, so they are fixed maturities, and they have withdrawal penalties. So your fixed deposits and your certificates of deposit. Most banks will not give a fixed deposit of less than 100,000. All right? Then you have something called wholesale CDs. These are fixed maturity, negotiable deposits. So a CD is a certificate of deposit, a negotiable instrument. So you get a certificate and you can actually sell it to somebody else. There's a market for that in the more developed financial markets. Then you have federal funds, or for short, Fed funds. These are short-term uncollateralized loans made by one deposit institution to another, or between the Federal Reserve or the central bank and a bank. Uncollateralized means they don't put anything down, there's nothing to secure it, but there's a cost, there's a charge for it, and the charge is the Fed funds rate, or in another jurisdiction, the central bank rate. Then you have repurchase agreements, which is the sale of securities with a promise to repurchase. All right? Bankers' acceptance. Those are letters of credit that are sold at a discount. So you have letters of credit and they convert them to something called a banker's acceptance. Then you have commercial paper. These are short-term paper, meaning 1 year or less. They are unsecured, all right? And in the US, the parent companies of banks can issue commercial paper. In our region, the banks can issue commercial paper. It's not something that's popular. The banks are quite small relative to banks internationally. So they don't, and they don't have the need to issue commercial paper. None of the banks here really are looking for further capitalization or more monies, right? So I remember if they issue commercial paper, it means they have to pay interest on the commercial paper. So the financial institution or deposit institution, has all of these range of deposits which are liabilities, and it has to decide how to manage the cost of those liabilities. All right? It has to because it wants to ensure that its cost does not exceed what is coming in, and so they calculate a gross interest return, which is your explicit interest plus your implicit interest. And so they go in, the banks go in and they price what they spend on managing accounts to be able to find that implicit interest rate. Okay? All right, any questions on that? All right, so we're going to look at a couple of examples. All right, so first, I want to look at the example with the average implicit interest rate, because banks need to be able to calculate the rates that they want to charge. So I know you're not seeing this so clearly, but it's example 18.3, maybe 3 or 4, and in this text is page 561. It's the chapter Liquidity and Liability Management. So in this example, the depository institution, I know you can't see, pays 15 cents to clear a check, right? And they charge a fee of 10 cents per check cleared. So it costs them 15 cents to clear the check, and they only charge 10 cents, okay? The customer receives a 5-cent subsidy per check. That's because it costs them 15 cents to clear, and they are only charging the customer 10 cents, right? So they can calculate the implicit rate for each of the services that they give, also called the average implicit interest rate for each demand deposit account. So, you would have seen on the slide the formula for that, which is the average management cost per account per year minus the average fees earned per account per year divided by the average annual size of the account. So that's the implicit interest rate, right? And so if the cost of management so in this particular example, if the cost per management is $150, all right, so 150, and the average fees earned is 100. The average annual size of account, it says $1,200, so the average size of the accounts, demand deposit account is 1,200, that's the average balance. Then the implicit rate of return would be, you do that calculation and you're going to get 4.166%, right? So it means that this is the return that they are getting, okay, on that account. So what the managers will do is they are going to change, they know what the costs are, all right, and so they are going to set their fees to manage that, to be able to get a return on those accounts, all right? So, and they also use this rate to be able to compete in the market. So they know what it's going to cost them to run these accounts, and they will play with that implicit interest rate to be competitive with the other institutions. All right? Now, you have the different accounts, okay? So, in order to work out, so they have the demand deposit accounts, and you also have the now accounts, all right? Which are the savings accounts. So, you want to see the bank wants to track its gross interest return. Remember we said the gross interest return is your explicit interest plus your implicit interest. All right? And so they can work that out as well. So, what is the return for the bank? In this case, there's a depositor. This depositor owes $250 per month for the first 3 months. This is example 18.4. $500 per month for the next 3 months, and $1,000 per month for the final 6 months of the year. The now account pays 5% interest per year if the minimum balance is $500 or more. It pays no interest if the account falls below $500, right? Depositor writes an average of 50 checks per month and pays a service fee of 10 cents for each check. All will cost the bank 15 cents to process. So the account holder's gross interest return consists of the implicit plus the explicit rates. Okay? How you find that? You're going to, because there's a minimum balance and there's a period of, because there's a minimum balance and the account doesn't have in the minimum balance at all times, then you have to look at the gross, you have to look at the return at the different periods. okay? So with sorry, excuse me. So when you look at the gross return, all right, it's the explicit interest plus the implicit interest. Now, they work that out to $61.25, okay? So your gross interest return is your $500, okay, per month, times the 5%, times, remember it's an annual rate, okay? But in this particular account, you had $500 per month for 3 months, all right? And then she had $1,000 a month for the final 6 months. So now you have to work that out. Can you see? You can see that, right? Mm-hmm. Okay. Are you able to follow in the book? In your book? So, bear with me for a moment. Okay, so you have the $250, all right? And you're paying 5% on that, but it's only for 3 months, so it's 5% divided by 4, all right? Or same thing as by 0.25. Then you have $500 for the next 3 months. So you're gonna get 5% on that, okay? And then you have the $1,000 for half a year. So it's 5% times or divided by 6, that's where you get 0.5 from. And then you have the cost, the implicit interest rate, which is your 0.15 minus your 0.05 times 50 over 12. And when you add all of that up, you come up with $94 and call it 38 cents. Now, the bank is just simply checking to see how much interest it is paying to the individual customers. All right? I'm not going to be giving you the calculation part of it on your exam, but you have to understand how the bank manages its liabilities. Okay, so it has these formulas that it uses to ensure that it is not paying a significant amount of interest, because it now has to look at the money it's collecting from its loans. Remember the gross return on the loan, and it's going to look at the gross interest it's paying out, and it has to make sure that it makes money there. All right? So you're seeing this part by part in isolation, but the bank has to put it all together on a monthly basis to see how much money it's in fact making. All right? And I'll put some questions in Moodle for you to work on, all right? And you have off the rest of the class because, yeah, I'm having a little, my nose is getting stuffy, so talking is not working out for me right now. Okay? Is that? Yeah, I could see you were working real hard to stay away. And now I'm out. You know, really out, but.
Yeah.
So I will pose some questions for you to practice, and the 2005 we go over them on Friday, 37